Well, okay, everybody, here we go. It is me, Gregory Mannarino, and it is you. I'm happy to be here with you. Let's get this show on the road here. Thursday, September 15, 2022. Let's start off with the economic news here, because if you were to turn on any one of the propaganda ministry programs, programs, that's what they're designed to do, program your mind, they're lying to you yet again. Imagine my shock here. So apparently we got this really good retail sales number. How about no? Because if you strip out autos, strip out cars, the number actually is worse than anticipated. But again, they're going to try to lie to you and tell you how great everything is now. Another piece of good economic news, apparently, is first-time unemployment claims came in lower than expected. All right, do I believe any of this data? Good, bad, or indifferent? No, I really don't. I think it's all propaganda. I really do. However, this is something I do believe, and it's something that we've been hearing about for a while. So loan delinquencies, it's early, are continuing to rise. People defaulting on their loans. People already, they're suffering. They can't make ends meet. You know this. They're borrowing beyond their eyeballs. In this phenomenon that you and I have talked about, like forever now, prior members of the middle class, they can't accept the fact that they are being pushed deliberately to the lower rung of society. Okay, so what they're doing, these people, is what you and I discussed they would do. Borrowing, and then borrowing some more to maintain the illusion of a middle class existence. But all they're doing is guaranteeing that they're going to fall to the lower rung of society. Again, you know this, all right? We're in the middle of a wipeout of an entire class of people. Central banks are going out of their way to create an environment where people need or have to struggle. Period. The end. That's it. And they're going to struggle a lot more as inflation gets a lot worse. Real wages continue to crater. That is what people are earning based against the actual rate of inflation. We know it's surging out of control. But meanwhile, they're having parties at the White House. You can't make this stuff up if you try to. Anyway, this is something that I think is pretty interesting. We heard from the IMF just yesterday, the International Mafia Fund, Monetary Fund, and they are warning of an explosion in the debt market, or I would say an implosion here. And it's getting some traction here on the mainstream media outlets. There's liquidity issues in the debt market. You and I, we've been so far ahead of the curve on this, it's unbelievable. Now, this is the SEC. The SEC is concerned, listen to this, concerned about debt market liquidity and is proposing reforms. People, this is the key here. And you know that. We've discussed this a gazillion times, literally. The whole debt market itself, first of all, if you were to layer in all the derivatives, no one knows how big it is. It's beyond anyone's wildest imagination. On the back of that, we continue to see global bond yields rising. 10-year yield, it was higher this morning, 3.42, I believe. It was actually higher earlier. It came down just a little bit here. There's a sell-off going on in an illiquid market, and it's starting to raise concerns. SEC, IMF, Market Watch, writing that article yesterday about it. But you already knew this, okay? But it's getting some traction. Okay, whatever. By the way, the railroad strike possibly has been averted. There's some kind of tentative deal. We'll see how that plays out here. All right. So with everything that we're seeing here, okay, and it's clear. It's been clear to you for quite a while now. Instability in the debt market has been causing this stock market to jump around yet again, like a yo-yo, getting this yo-yo effect, and it's concerning. It is concerning. MMRI continues to rise. We hit an all-time record high just a couple of days ago. The Mannarino Market Risk Indicator. Link in the description of this video. Free to anybody who wants to look at it. Okay, look, I don't think we need to panic, but we need to be concerned here. What are we going to do moving forward? Number one, we're not going to change a damn thing. We're going to bet against the debt, become our own central banks. Gold and silver this morning are under some pressure. Not much, but under pressure nonetheless. The U.S. dollar is slightly weaker. I already mentioned the 10-year yield, 3.42-ish, around there. Bitcoin back around 20,000. Crude oil under some pressure this morning as well. Okay. With regard to, look, there's never a reason to get panicky about this. Yes, I am still buying ticker JEPI here. The dividend is a massive hedge. It's a massive hedge. So I like that dividend payment here. I've been buying more of this at least every week now for quite a while, sometimes more than that. Anyway, let's look over at the market. As I said, I already laid out what's happening. Stock futures are slightly in the red. All of this, people, all of this is dependent on debt market action. You all know that. And look, I've been kind of wrong for a while now with regard to, I believed, and I still believe this, okay, maybe I'm deluded, you can let me know, that central banks are going to do more. I don't feel like central banks are yet at the moment where they're going to let this whole thing go, because that's eventually what is going to happen here. I believe central banks at one point are going to start buying even more debt. Look, the European Central Bank already told us they're buying unlimited amounts of debt across the entire Eurozone. The Fed is doing the same thing. Okay, that moment of maximum saturation that I've described to you many times, it's very simple to understand. When the side effect of money creation and asset purchases overcomes any good that it might be doing, if you want to even call it that, to keep rates suppressed, we're very close to that point. We're seeing inflation surge out of control, which is the direct effect of money creation and central banks buying assets. But again, what bothers me more than anything else, and they were talking again about it this morning on Bloomberg, is what the Fed's going to do about it. Are we going to get a 75 basis point hike next week, or is it going to be a 1%? But no one's talking about what the Fed has done to get us here, where we are today. And there's no accountability, and there won't be. But they're going to have parties at the White House to celebrate the Inflation Reduction Act. You can't make that up. We are living in some kind of twisted reality. And I think some of it is designed to get people like you and me extremely aggravated, pissed off, and then they wonder why. Yesterday, we heard from the Homeland Security chief over there saying if you don't trust your government, then you are a terror threat. Really? People are supposed to look at their governments with skepticism. Okay, maybe this guy hasn't studied history or what our forefathers wanted. Okay, this is why they wanted the people to have the right to bear arms, because they realized at one point the government could turn on its people, and it's exactly what we're seeing here. The government has been taken over by central banks who have now become the governing body of the world. Okay, but no one's taken action against them. The central banks are public enemy number one. You know that better than anyone in the world if you follow this blog. I've been telling you this since I don't know how long. And central banks, again, going back to my thesis, they're not done. They're not done inflating. They're not done creating inflation. They're not done pressuring the middle class. They're not done, making slaves to the system, people dependent on it, so they can issue in their new system, period. And that's what they're doing here. In direct collusion with the government that they throw in front of people's faces, which is nothing but theater. Anyway, going back to this market here, look, this issue here with rising bond yields, sell-off in the debt market is really getting attention. And that's interesting to me. I mean, the SEC, the IMF, Market Watch. Let's see if we hear more about this. Look, people aren't that stupid. I don't think they are. At least maybe they are. Not you, not me. We're on top of the situation. But people realize, I think, that something's very wrong. And I'm just waiting for, look, people aren't going to do anything until it's way, 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 way too late, as this always plays out that way. People always wait to the last moment, and then it's just too far gone. And that's, we've reached that point already a long, long time ago. If people were to take to the streets, if people would, start to realize that it is the central banks of the world that are creating this problem. This current president, the last president, I know a lot of you don't want to hear this, but President Trump called for negative rates. President Trump called for a weaker dollar. All President Trump wanted to do was have the Federal Reserve continue to inflate the stock market by buying assets. And that's exactly what they did for him. They did the same thing here up until recently with the Fed hiking rates for Bidenstein. Obviously, they did this with Obama too. It's these people's faces and complexions and hairstyles might change, but it doesn't matter. They don't work for you. They work for the central banks. And if you've been duped into believing that any one of these people do work for you, well, you've been just that, duped. All right, look, I'm out of here. You know what to keep your eyes on today. Watch that 10-year yield. Watch the MMRI. Let's keep our eyes on the Dixie, the relative strength of the dollar. And think about what this means for you. Understanding that the environment we are in is, in fact, going to get much, much worse by design here. Okay, if you're already struggling, you're in a lot of trouble. You're in a lot of trouble. All right, look, I'm out of here. Love you a lot. Please share the video. Get it out there. See you later.